Welcome to our webinar about supply chain resilience in the light of new geopolitical realities. This event is organized by the European American Chamber of Commerce, New York. My name is Yvonne Bendinger-Rothschild. I'm the Executive Director of the EACCNY, and I will be moderating today's discussion. Supply chain resilience has moved from a good thing to keep in mind to a hard reality. Geopolitical competition, pandemic repercussions, and the impacts now from the war in Ukraine are the driving forces for a realignment of trade relationships and the new supply chain footprints. Transatlantic relations and trade are key drivers of global trade, yet the US and the EU are facing a new geopolitical environment that requires all of us to rethink what resilience really means, and we find ourselves in a completely new and more volatile world. To help us better understand what we're dealing with, we will be joined by Douglas Bell. He's the Global Trade Policy Leader at EY. Ajit Menon, he's a Managing Director and Head of Structured Trade Solutions at HSBC. And Michele Ruta, he's the Deputy Division Chief, Strategy, Policy and Review Department at the IMF. Doug, let me start with you. Can you just give us an overview of the latest geopolitical developments and how they're challenging supply chain right now?
Sure. Well, thanks, Yvonne, and it's great to be here and looking forward to the conversation. Actually, I'm going to take just a slightly historical view in the sense of, I want to just highlight the COVID-19 pandemic, which in of itself is not a geopolitical event. But really, if we think about the interpretation of that and sort of the vulnerabilities that it highlighted for policymakers, I think that's really a kind of an important foundational point, because it really changed attitudes, I think, amongst certainly government policymakers, whether it was the specifics of responding to that, but just more generally, sort of the realization that supply chains had become concentrated, that this overall issue of resiliency from a public health perspective, of course, but then that's been sort of extrapolated into sort of broader concerns. He then adds how are real geopolitical developments. So, for example, U.S.-China tensions that have also been escalating over the last 3 to 4 years. And you start to see how, from a geopolitical and from a policymaker's point of view, this issue of lack of supply chain diversification, the potential vulnerabilities that creates, so whether it's in the technology space, the public health space, and increasingly, you see governments taking measures to address that. So, whether that's, incentives, putting in place certain types of restrictions, to sort of reinforce, inshoring or, domestic nearshoring, all these type of developments really stemming, and for different reasons. In the case of U.S.-China, where you have, a strategic competition going on, pressures building up, on companies to reassess and redefine what resiliency really means. And then the last, I think, geopolitical development, I think that's been particularly impactful is been the Russia-Ukraine crises. And again, it's, there's the effects that have shown up in the energy markets, which are obviously quite consequential, particularly for Europe. But I think one of the interesting things, and sort of is what we've seen both from a corporate perspective and from a government perspective, is sort of the implications of that. So circling back to U.S.-China tensions, for example, we've gone through a period where I think both policymakers and corporations have become a little bit alarmed about the potential for a China-Taiwan crisis and what that would imply for supply chains. So you have this sort of stew that's being created with new ingredients being added in, it seems every 6 months or so, but really creating a set of fundamental questions board level conversations about what is it resiliency, what are our vulnerabilities to some of these geopolitical events. And I think that's really starting to drive, a rethink of supply chains, both for geopolitical reasons, in some instances, just because of, either public health or, Suez Canal closures, these type of things. But there's a fundamental geopolitical overlay to all of this.
Yeah, I completely forgotten about the Suez Canal closure. That was something else. I think it's. I want to dwell a little bit on what you said about defining what resilience means. And I want to give everybody a chance to just share their thoughts on that, because we obviously, supply chain resilience is not a new thing. It's always been out there. It's a whole industry of people working on that, including some of the organizations you work with. Michelle, do you want to comment, just to share a few thoughts on how this resiliency or the definition has changed, and what some of the what consequences that has in for governments, but also for companies?
Yes, hi, and thank you, Yvonne. Thanks for the invitation. So actually, let me try to take a step back at first. As Doug was saying, there have been increasing tensions and a surge in geopolitical risks. And this has led many to think that we are in a phase of deglobalization, decoupling, or as you want to call it. Now, if we look at the data, in reality, we have both good news and bad news. So the good news is that we don't see deglobalization, decoupling in the data, in the trade flows data. So if we look at the trade to GDP ratio, which is a standard metric to measure integration, it has been fairly stable since before the global financial crisis for the world at around 50%. Now, that doesn't mean, obviously, that things haven't changed. Services trade has been more dynamic than goods trade. South-South trade has been more dynamic than North-South and North-North trade. But overall, has been fairly stable. We had periods in the past of deglobalization when World War I started. The trade to GDP ratio was for the world was 40%. And when World War II ended, it was below 20%. So that's really deglobalization taking shape. And since then, things have been very, very different. Now, on the other hand, and this relates to what Doug was saying, we have seen a worsening in the public discourse around global integration and a worsening in the trade policy landscape. Now, if we think about the first, the Google searches for words like reshoring, nearshoring, friendshoring have been largely increasing in recent years. Now, if we look at companies' presentations and documents, doing a textual analysis again shows that in recent times, these keywords have been popping up and increasing. On the policy side, we had the first wave of measures following the global financial crisis. Then, as Doug said, we had another surge around the US-China trade war in 2018. And then we had another wave, first with COVID, the many export restrictions in health-related products, and then with the war in Ukraine. Think of the export restrictions on food, just as an example. So all these measures are coming up, and this may suggest that if there is tit for tat and retaliation, we may be headed towards more deglobalization. It's a possible risk scenario ahead. And this would have consequences for trade, it would have consequences for global value chains, and more importantly, it would have important consequences for global wealth. So at the fund, we recently had a study on geoeconomic fragmentation, where essentially we were trying to look at the literature, the various papers that have been written in recent times with various scenarios, and try to quantify the cost of geoeconomic fragmentation. And as you can imagine, this is extremely difficult to do in practice because you need to make scenario analysis on things that are difficult to assess. So if we focus on the effects of trade fragmentation alone, the studies have quantifications that range between 0.2% of GDP in a very mild scenario to 7% of GDP in a more serious scenario. Now, this is just focusing on trade. A lot of growth comes from ideas, new ideas, and technology. So if you factor in the consequences of technological decoupling, the cost for the world economy would be even larger. They would range between 8% to 12% of world GDP. So we are talking about very, very large effects. And obviously, they don't even take into account other type of consequences. Obviously, it would be much more difficult to cooperate at the global level on important goals like climate change if the economy is at the same time breaking up.
Interesting. Ajit, what's your take on this?
Yeah, look, I mean, from our perspective, supply chain resiliency is a topic that we discuss with our corporate clients in every single meeting, right? If I were to simplify it, supply chain resiliency for our corporate clients means a switch from just in time to just in case, and just in case at an affordable cost. We've had the past 2 years where our corporate clients have had stock outages. Some of them haven't had stock for a couple of weeks, and that impacts production. So the world is now changing where large corporations earlier were working with a large number of suppliers, right, in an attempt to diversify and reduce the cost of sourcing. That's now changing to a situation where large corporations want to diversify, but yet there's a contrarian point of view. They want to work with a smaller number of suppliers, but then work with these suppliers in a way that they're almost part of that core ecosystem, right? An extended arm of a corporation. And that would mean being able to support them extensively in their financial journey, right? At a point in time when corporations were really pushing out significant payment terms, we are now seeing a lot more liquidity being injected into suppliers, right, early on into a transaction, and not just into the immediate supplier base. Corporations are now looking at going deeper into the tiers, right? So how do you enable liquidity flowing through the supply chain ecosystem and not just, sort of providing liquidity at the first tier? So that's how we are talking to, clients about supply chain resiliency, and that's how sort of they are reacting to it. We did hear comments about supply chain dislocations and nearshoring, but the fact is that we haven't really, what we were expecting pre-pandemic, that's not how it's panned out, right? The supply chain dislocations have happened, but it's still relatively regionalized as opposed to, being right at your doorstep. So that's how we are sort of seeing clients react and clients think about building a resilient supply chain.
Interesting, but that bears risks in itself. No, I mean, now we have the German Lieferketten Gesetz and the Slave Labor Act here in the U.S. I mean, if you're getting closer to, or if you're tightening the ecosystem that you're working within, that creates a whole another set of risk factors, doesn't it?
It does, but if you think of it, it's horses for courses, right? There are sectoral specifications that kick into each supply chain, right? An apparel sector would be very different from a technology sector, which is very different from a consumer brand sector, right? So it would depend on, what sectoral trends are and which is the right market for sourcing and what are the alternatives that you have, right? We've talked about Mexico being a fantastic alternative to China, right? But what does that mean? Are you just shifting a particular vendor into Mexico, or are you establishing a new vendor into Mexico? But then depending on the sector, what is the ecosystem that needs to move from China to Mexico is an interesting question, because there are also those cost implications. Remember, the whole supply chain fragmentation, if I may use the word, started with the sole purpose of cost, right? It was all a cost play. Certain markets had core competencies. They were closer to where the production was. They had the ability to add scale, and that's how it all started. It's the paradigms have shifted a little bit, right, as we think about with what has happened over the last couple of years. So that's how we think about it. And again, as I said, it is a slightly sectoral in terms of the trend, but by and large, the thought process is, how do I source just in case at an affordable cost, and how do we or corporates work with a fewer suppliers, so that you can inject that liquidity and work with them extensively, almost as part of their ecosystem, as opposed to sort of treating them as at arm's length.
Yeah, and you want to have them closer, because then you can monitor them much better. Michelle, how is that affecting supply chain performance?
So maybe before I get there, I just want to follow up on what Ajit was saying. The way we see this from a more economics perspective is that firms react to shocks. These shocks can be related to climate change, can be other natural disasters such as earthquakes, can be shocks related to changes in the geopolitical context, such as one country becoming suddenly riskier. And they will tend to do a cost-benefit analysis in order to decide whether to relocate their subsidiaries or change their supply chain structure. Now, when there is a negative shock, obviously there is an incentive to change. On the other hand, firms will also take into account the cost. And the costs are related to the fact that there may be sunk investments, capital that have been put in some place. Second, there are relationship-specific investments. So these are the relationships that have been built over time with customers, with suppliers in a certain location. And obviously, these things will create inertia. That's why we don't see, while some people imagine that after COVID, there have been huge changes. You don't see that as much, because obviously firms take into account these cost factors. And obviously, and again, this goes in line with what Ajit was just mentioning, these costs vary. They vary by sectors. You can think of a sector like the auto sectors or the high-tech sector to have much more important investment and relationship-specific investments that create more inertia relative to other sectors that would be easier to relocate. Now, in this context, obviously, there are also policies that enter into play. And governments, for one reason or another, may have an incentive to provide subsidies or use trade policies in order to affect these decisions. And I can get into this later. So in some cases, this can provide an improvement, and that's generally when there is some market failure that might have led to excessive concentration. In other cases, they may intervene where there is no market failure. And then in this case, the policy intervention does not bring to an improvement. And this, as a consequence, may lead to either more costs for the government, which implies more costs for taxpayers at the end of the day, or more costs for the firms that will imply higher prices and therefore more costs for consumers.
Yeah, I mean, we will get to the policy part of that in a minute. Doug, what are you seeing with your clients? What are they doing? What are the questions that they're asking you? What is the advice they're looking for from your team?
So I think just to sort of capture a little bit of what's been said, fundamentally you have the perception of risk has changed, geopolitical risk has changed. And I think the first thing I would say is that companies and clients are starting to recognize that geopolitical risk is a very meaningful factor in sort of thinking through investment decisions. And I think it even starts before that, really, because I think, some of these risks are pretty significant. So I think the first question that companies that we're seeing is what is our vulnerability? How exposed are we? This gets back to some of the point that was made earlier about what's your tier 1, tier 2, tier 3 supply chain look like? Where's that actually coming from? Assess. So it's starting with, okay, we have a different risk profile that we need to take in mind. What are our vulnerabilities under those profiles? And then you start thinking through, well, what are sort of the mitigation strategies that you can start to pursue? And that's a very complicated sort of engagement, because it really is, takes into account not just, political risk is a factor, but it's not the only factor. You need to, all the cost efficiencies, market conditions, your resources are not endless. You have to prioritize, but that's where, having gone through and sort of identified vulnerabilities, you can kind of get a greater sense of what it is. So what we see are clients really starting to sort of go through that process, helping them to sort of understand. And then, in terms of our practice, it's not just at these geopolitical type assessments, but it really gets into sort of the nitty gritty of, supply chain, operational decisions, CapEx decisions. And so I think what we're starting to see is that, this is a process that will play out over time. You're starting to see some big players, make some pretty big changes, like the Apple, moving to, a lot of its production to India. But I think most companies are, probably on a slower pace, and it'll really be kind of balancing the supply chain considerations, being in the market, right? I mean, in some cases, it's pretty important to have a domestic presence. And so weighing all those things, it's just got a lot more complicated, and, sort of ask those questions, but that's going to be playing itself out over, I think, a number of years.
Interesting. So what I'm hearing here is, this is all kind of, starting, but hasn't really had any serious effects in terms of actually, I mean, obviously, realigning your supply chain is a process. I mean, it really takes a long time to get all of this organized and actually implemented. Ajit, how is this, looking at this, how is it affecting trade finance in particular, and the global financial system more broadly?
Absolutely. And I think, we've had a very, very interesting last 48 months, right? Through this entire sort of change. From our perspective, what we have seen is physical and financial supply chains are as deeply integrated as they can be at this point in time, right? There was a divergence to this clearly, but that's clearly changing, right? And that's a function of the amount of cash that large corporations have put just to make sure that stock outages is not a problem for them. Despite that, we've seen stock outages becoming a real issue for corporations. And therefore, there is that realization that there needs to be deep integration between physical and financial supply chain. Right now, as we discussed earlier, there are sector-specific nuances, but by and large, there is a need to move to a just-in-case strategy from a just-in-time sort of a strategy that we have seen historically, right? Supply chain resilience is a key KPI for our customers. They need to deliver this to their boards. They need to deliver this to their shareholders. And there is a need, therefore, to be able to quickly respond to demand and supply shocks in the backdrop of a recessionary outlook. So this is also something that we are seeing. Now, from a trade finance perspective, closer to home, when we think of pure play financing, we are seeing that both buyers as well as suppliers, they are reacting to the strain in the supply chain, right? Suppliers need working capital support, right? And they want more lead time. They want more support from buyers, right? They want funding earlier and deeper into trade cycle, which is where trade finance kicks in. We did a recent survey with our corporate customers, right? 56% of them said that they have changed the funding models for their supply chains and for their suppliers. What we have also seen is that the cost of funding gap for an investment grade versus a sub-investment grade counterparty is significantly changing. Now, what that means is that therefore, there is going to be an increased reliance on strong anchor buyers by their suppliers to leverage off the strong credit that these buyers have, and therefore get cash acceleration from these transactions, right? This wasn't the case. I mean, there were still such programs being run, but over the past couple of years, we are seeing that despite core procurements, especially in the Americas, turning slightly muted given the economic outlook, the reliance on trade financing instruments where suppliers could leverage off buyers' credit profile and get sort of cheaper cost of funding, that has increased. Right. We're also seeing, companies doubling down on digital and technology to integrate supply chains, enhance visibility, and manage all of these supply chains, even the trade finance aspect of it in a cost-efficient manner. So this is how these are some of the changes that we have seen over the past 24 to 48 months, but we suspect this trend will continue as we move forward and as supply chains look at stabilizing into the new world order.
Interesting. Michele, how does this play out, on your level at the IMF? How is this realignment affecting, global dependencies and the global economy as a whole?
It's a good saying, and actually that, as you clearly summarized earlier, this is a process. It's not something that is impacting the aggregate flows in a visible way yet. What we have seen is some short-term phenomena. Which is the reason why we're talking about resiliency and GDC resilience right now. We didn't use this word, and we didn't honestly worry too much about it, even if maybe we should have before COVID. Then when COVID arrived in a very short period of time, in just a few months, mostly because of the lockdowns that affected both the demand and the supply side, we saw a huge decline in trade. That was the time where it was so difficult to get supplies from other countries, and not surprisingly, and the research at the fund and other research has shown that the global value chain sectors were particularly affected. What is less discussed is that the trade bounced back very, very quickly. So even if you compare it with the global financial crisis, there was always the same V shape, but it took a lot longer during the global financial crisis for things to go back to normal. While during the COVID crisis, if we exclude some sectors like tourism, which were affected by changes in preferences and continuing lockdowns in some countries, for goods trade, it bounced back very, very quickly. And that means, in practice, that GDCs have been pretty resilient. That's exactly how we would define, and actually Ajit defined resiliency earlier. It's the ability to react to shocks. Now, a different thing is that, as Doug was saying, is that the fact that we have seen that big decline scared many people and many firms off. The fact that there are shocks related to geopolitical tensions, the fact that there are changes in policies, those may ignite a process of reorganization of global value chains. And this will take time. And so to see it in the macro statistics, that will take time.
Interesting. Doug, what are you seeing from the, how does this play out on the company side? What are you seeing with your clients in this context?
Yeah, well, I mean, I think for companies, there's one of the challenges is that there's sort of this emerging gap between, while companies are sensitized, they understand these issues of resiliency, all the sort of practical, implications, what Ajit was saying. At the same time, you have governments now really sort of intervening in a very serious way, and in a desire to sort of shape supply chains in a way that we haven't really seen, well, certainly not in most of the business lifetimes of most of us. And so I think firms are sort of grappling with sort of the incentives that are being put in place, through these sort of industrial policies. So in the case of the US, it's the CHIPS Act or the Inflation Reduction Act, as well as some of the coercive measures, and particularly that whether it's in export controls. And so I think firms are really trying to sort of manage through sort of these kind of competing tensions and, figure out what's sort of the right profile for them to sort of, what works with their cost structures, which sector. I mean, that was a point that was brought up earlier. This is really a sector by sector story. It really does make a difference. Perceptions of risks vary by sector. We're not necessarily, countries are not necessarily as concerned about where maybe their socks and t-shirts are coming from, but some of the higher technology sectors, it's a very different story. And so I just think that the calculations now are just a bit more complicated. And again, the comment that's been made is sort of the reality of trade flows in the macro sense and sort of the perception of where things are going. And I think, over time, I think our view is those reality of those trade flows will start to change. Maybe not in the aggregate, but the composition is starting to sort of shift. And I think companies are a big part of it. But if you think it through, it's like millions and millions of small decisions that's being made in the private sector that it's going to kind of, in aggregate, are going to make those changes.
Yeah, we're seeing the same thing. And when we just had a really interesting discussion with Sabine Weyand, and I think we had around 20 CEOs and CFOs in the room. And those were exactly the questions. I mean, they're all, strategically now thinking about where to go and where to source and how to, where to find partners, whom to partner with. But I think there's a lot of movement going to happen in the next couple of months and years. We have a question.
Can I come in, Yvonne, on this part? Mm-hmm. So I think this is an interesting comment that Doug was making, and it reminded me of a study that we did a couple of years ago. We are trying to understand the implications of COVID for the structure of global value chains. So we went back to an episode which is very different. It's the earthquake off the coast of Japan in 2011 and how it affected the global value chains. It's obviously a different type of shock, but at the time it heavily disrupted supply chains. In fact, for instance, Toyota North America didn't have access to key inputs for many weeks after the earthquake took place. So when you look at the long-term data, so for several years after the earthquake, what you see is that there was a reorganization of global value chains. So firms, if you want to simplify it, moved out of Japan, especially the ones that have been more exposed. But interestingly, we found no evidence of reshoring, no evidence of nearshoring. Policies really did not affect these relocation decisions. What was driving firms' decisions were economic fundamentals. So what happened is that in practice, firms decided to source more or relocate in developing countries that were large, and this goes even beyond China. Even when you exclude China, that is still the case. So this, I think, it is very very important because it is telling of how firms think about these decisions, how they internalize the risks and reassess their global value chains. But it also tells you the difference with the current situation. Back then, around 2011, policies were not as prominent as they are now. And as Doug was saying, now firms are probably asking themselves how the policies will change in the future. And here, as I was saying, there are risks. I mean, obviously, policies may address market failures and provide an incentive, but there are also risks in the sense that these policies may distort incentives in a way that does not go in the direction of economic efficiency.
Yeah, good point. Especially about the policy changes. We have a question from the audience that is a little bit more sector specific. Food. What's the panel's take on the food supply chain in the U.S. and its impact on retail sales price levels and revenue? And what are your near future expectations in that context? Who wants to take that one? I mean, it's not geopolitical. It is geopolitical if you think about it when in the context of wheat coming out of Ukraine. Others are, more related to climate change. There are a variety of reasons behind the food prices going up. We have the eggs price, the egg price that went up due to the little bird flu that we have here in the U.S.
Yeah. I mean, I think, Yvonne, you're sort of making a good distinction. I mean, I think this is a little bit of a sort of an inflationary story, and there are sort of geopolitical elements to that. You mentioned Ukraine. It's climate change. I think I don't really feel qualified to sort of make a sort of judgment on where food prices are going on in the U.S. But I do think you do have to sort of think about sort of the larger macro inflationary environment, where food chain, where interest rates are going, these type of things, to really sort of think through that question. I don't know. Maybe the economist on the panel would like to comment.
Yeah. So likewise, I'm not competent at all to talk about supply chains, food supply chains in the U.S. What we have done is to look at global food markets, and this is a big concern. So that we thought back in 2020 that problems would start in food markets with COVID. At the time, things luckily did not go in that direction, and global food prices have been fairly steady when COVID started. However, in part due to climate change, things got worse over time, and food prices started going up. And then, obviously, as Yvonne, you correctly said, with the war in Ukraine, that's when we had a food crisis with global prices going up at the levels that we had not seen since around 2011, 2012. And as you said, I mean, the reason was pretty clear that Russia and Ukraine together are exporters of key staples like wheat. And in that, for that product in particular, they used to export around 25% of global exports. So that supply was suddenly off the market. And what happened is that many governments got scared. And this generally gives rise to what you can call the scarcity nationalism. So countries start imposing export restrictions on food products that push prices even higher up. Now, this is a problem for several reasons. First is because obviously it affects food supply chains. Second is because these higher prices lead to consequences for food importing countries. Now, if you look at the global map of food importing countries, very often these are low-income countries. There are very few alternatives. When food prices go up, especially because poor people tend to spend a large share of their income on food, this has devastating effects. And finally, a third problem is that these measures, these restrictions, and these problems undermine the trust in global markets. So that's why you hear more about resiliency and bringing back home production of certain staples or food products, or the same logic applied to medical products. And it's a problem. The problem is that nobody's asking, how do you feed the very large population that we have, especially in the context in which climate change will bring more disruptions. And obviously to do that, you probably need more open trade and more efficient markets.
Yeah, absolutely. Because I mean, if you when I I mean, I looked up some population numbers and square mileage of countries, and Ukraine is roughly twice the size of Germany. The territory. And because I was like, how come they're producing all of this wheat? Where are they growing this? And when you are in Germany, there are lots of fields of wheat, but obviously Ukraine being almost twice the size, is a whole different ballgame. But I think Michael Sass was asking that question from he's a EICC member. I think there's a point to be made, because this turns quickly into a geopolitical issue, as we saw with what's happening in Ukraine. I mean, nobody thought, that this is an issue. We should have all realized that Ukraine is nicely tucked in between Russia and Belarus, and not such a safe area in the world. And then this wheat is being sold in the Middle East. In Asia, for noodles, in the Middle East for the pitas. This can create a whole new set of geopolitical problems.
No, and absolutely, and I think what complements this in a negative way is protectionist measures by governments, right? So, for example, India has barred exports of wheat. Right, food security kicks in, and they know that at this point in time, taking care of the population at home is more important than really exporting the grain. Right, so it's a combination of three factors. Right, it is geopolitical, it is protectionist measures, and then what is also happening, and we see that a lot in the trade finance world, is that input costs through the supply chain are getting passed on, right, upstream. And therefore, the end consumer is actually taking on all of the impact of the inflation, right? The rising interest rates. And therefore, I think, again, not an economist, but it seems like this trend is here to stay for the short term at least.
Yeah, for sure. Let's get back to supply chain resilience. We have another question from the audience. What are some of the key performance indicators of supply chain resilience? Doug, how are you when you're talking to a company? How is EY measuring their exposure?
Well, I can speak at it from more the geopolitical side. I mean, I think there's kind of two parts to that question. I mean, there's the actual, very specific, KPIs associated with, manufacturing, production, on-time delivery, et cetera. But from the geopolitical side, what we really try to do is disaggregate that sort of overall perception of risk that I was describing to you. To be meaningful, you really have to sort of break it down. So, what is the geopolitical risk? What's the regulatory risk? What's the sort of country-specific risk? And then what are sort of the societal risks? It's sort of the model that we use. So understanding that, helping companies to sort of develop their sort of risk governance management. It's one thing to have sort of the abstract understanding, well, risk has changed, but like as a company, you need a rigorous process to sort of go through, understand those four dimensions that I mentioned. The other thing that we do is, we have kind of what is called a scan, focus, act approach, which is, you scan for the risk, you focus it in on what it sort of means for your business, and then you act. And so particularly for that last piece of it, it's really important that you integrate this risk analysis into your overall strategy operationally. So ensuring that you have the right people, contributing, at the table. Historically, some of this type of activity was a little bit ghettoized, and it wasn't necessarily, it was in its own little area. But really, helping companies to sort of ensure that it's part of the, a seat at the table for sort of all the type of conversations that we've sort of been describing here that companies are having to think through.
Yeah, interesting. We have a question from the audience. Addressing those risks with sophisticated insurance products and hedging against loss of income and etc. Who wants to comment on that?
Yeah, I think I can take that. And look, risk management is front and center, right? In these times, an insurance product is nothing but a risk management product, whether it is a foreign exchange hedge or an interest rate swap. I mean, it depends from, sort of what is the core issue that you are looking to solve for. I mean, a financial product is just a complementary way of solving for it, but the core issue is really shortages. The core issue is ability to source at the right price, and ability to ensure that there is no disruption, right? I think those are the key, sort of issues that you're looking to solve for. What we have seen is counterparty risk, for instance, is become a key priority for our clients, right? As we look, and I mentioned earlier that there is a desire to reduce the number of core providers and do more with these, but equally then, how are you managing counterparty risk with these providers to ensure that you're still operating within the realms of manageable risk, right? And therefore, these are some of the things that we continue to see. And yes, insurance could be one such option. A lot of our clients look at doing reward and risk transfers through receivable solutions, for instance, right? And that's flipping the supply chain upside down, where they say, could we get our early cash flows in, leveraging the credit of our customer, and therefore redeploy that into the manufacturing process, and therefore injecting liquidity. So there are various tools that are available at your disposal depending on what is the core issue that you are looking to solve for. But I think fundamentally resiliency needs to be solved at a much more deeper level, right? And you could use some of these tools as bolt-ons as you look at building a resilient, global, robust supply chain.
Interesting. Thank you for that. And before I get to the IRA, let's move on to EU versus US challenges. Doug, governments are increasingly playing a role in supply chains. How are the developments in the US, IRA, and other policy changes impacting corporates, EU policymakers on both sides of the Atlantic?
It's a great question, Yvonne. I think the IRA is sort of interesting because there's certainly been a lot of press and focus on sort of electric vehicles and batteries, and I think that certainly is meaningful and sort of an area of dispute, in part because the concept of protectionism has been sort of raised. The U.S. has been very clear that as it puts money into these types of programs, there has to be these domestic content requirements, and really is sort of stepping back from some of the kind of the core principles of the WTO and the multilateral trading system. But I think the IRA in particular is interesting because there's a lot more to it. And then this is where I think gets into some of the larger strategic questions, particularly for EU policymakers, where if you think about sort of the shock that the EU has experienced, on its economy from the energy prices and having to sort of, move away from its supplier relationship with Russia and what that's done to prices. And then you look at what's being done in the IRA, which is, obviously electric vehicles, but there's a lot of the money is focused really on, renewables, green technology. And really, you can almost think about it as a play by the US to sort of, enhance its role as sort of a low-cost energy producer, and really as it moves into more of the renewable space. And I think for Europe, that creates some big and fundamental challenges, because it's not, and it's hard to see itself as a sort of a low-cost energy provider. And I think that's creating I think that's behind a lot of the angst that we're seeing from EU policymakers, is that this is, in some regards, a fairly fundamental challenge to the European manufacturing. And so I think the solution obviously is to push back on the US, but I think increasingly we're seeing measures being taken by EU authorities to really, well, we can play this game too, and trying to come up with its own sort of incentives to really sort of compete with the US, and also with China, frankly, which is is sort of the granddaddy of kind of supporting industries and and stuff. So I think in general what this portends is just sort of continued increasing levels of government intervention in the economy, probably mostly focused on incentives. But there is a role of sort of that economic nationalism and protectionism that's coming into play. And so I think for companies, that's both a concern, but it's also an opportunity, right? I mean, incentives can reduce the cost of investment, and so I think it will increasingly I think that this a factor that companies are having to think through, sort of balance the competing pressures that they're feeling from maybe their home markets and authorities versus the incentives that are being offered if you, for example, if you're a case of a European multinational. So another sort of ingredient that just makes it all a bit more complex.
Yeah, for sure, to say the very least. Michele, what's your take in this regard?
Yeah, so I mean, the IRA, the Inflation Reduction Act, really has the main goal is about the climate transition. That's a big component of it, and I think even as Doug was speaking, there are two issues that are in part overlapping. So one is the fact that the US, and as a response, increasingly the EU, are seeing industrial policies as a tool, which was something that was very different from just a few years ago. And then second, there is the question that you were asking at the beginning on the policies that can improve GVC resilience. They may not go in the same direction, and I think in this case they don't. So if I think about measures that improve GVC resilience, the first thing that would come to my mind is diversification. We would want to have policies that allow diversification so that firms in the presence of a shock can quickly move from one supplier to the other, and that would improve their resilience. Now, if I think along these lines, the measures that come to mind are in three directions. The first is improve infrastructure and logistics. So we have seen during COVID, big problems, especially at ports, that were reducing the resilience and negatively affecting the resilience of firms. So that would be the first. Second, there is information broadly defined. With COVID, we realized that we actually don't know that much about the structure of these supply chains, and often firms themselves don't really know everything they should know. And so there are various ways to improve information, including through digitizations and improvements in trade facilitation. And then the third is really about trade cost. So if you want firms to easily change the source of their supply in the presence of a shock, then the non-tariff barriers that make it more difficult are the first target. And in fact, on this, we had a recent study looking specifically at Indonesia. We had very nice data at the firm level, and we knew the firms that were facing more non-tariff barriers on their imported inputs relative to the ones that were facing less. And what we found is that in presence of a shock, the ones that had more non-tariff barriers performed worse than the latter. So if you want to improve resilience, try to reduce those costs for firms. So in some sense, this debate, which is I can say something later, but on the new industrial policies, does not directly affect the question of improving resilience for firms.
Yvonne, you're muted.
Sorry about that. We have 4 minutes left, and just a quick around to everyone. What are the geopolitical distortions we're going to expect in the future, and will they be consequential for supply chain resiliency? Doc, do you want to start on that?
Sure. So we did our recent 2023 outlook, and what we called, the sort of the geopolitical environment we used, it's a bit of an oxymoron, but we called it stabilized volatility. And by that, I mean, we're at a sort of heightened level of volatility. We don't necessarily see sort of the big picture shocks that, we maybe saw over the last year, but there just will be a continued level of, friction, tension in the system. And, I think for, companies, there'll be a combination of that. And then I think the other piece of it that we sort of see is sort of this, and I think this has kind of come out in conversation today a little as well, is really sort of policy trade-offs. So, and I think, the last comments made it pretty clear where you have, governments want to sort of reduce their vulnerabilities, improve resiliency, but then you have these sort of protectionist policies, one of their tools in the kit, and it doesn't necessarily really help them. And so I think those sort of trade-offs really are across the board, and I think that'll impact companies. So it's in the energy sector, and climate change, and all these type of things. So sort of those two ideas, I think, are going to characterize the environment going over the next year.
Ajit, what are you seeing?
Sure. No, I thought as you were asking this question, I was reminded that VUCA was a term coined way before supply chain resiliency became a thing, right? So volatile, uncertain, complex, and ambiguous. I suspect that's how it will remain for the short to medium term. What's important is how do we sort of continue to progress on building a resilient supply chain, and that's a journey, right? And a bunch of things need to be looked at as companies look at focusing on that, right? Some of them that we've been sort of talking to our clients is to really about, talk about how do you defend the world order, right? Business models are shifting. How do you design yourself around the shifting business models? How do you reinforce existing relationships while you are building out new partnerships for the future? That's a key thematic that we are seeing across corporates emerge. How are you financing your business, right? There are a lot of thematics there where you're moving away from traditional working capital funding methodologies to integrating supply chain, both physical as well as financials, right? How are you focusing on some specific parts of your supply chain, whether you could really reshore, not just around blockages, but really focusing on resilience. And then, core concepts of ESG, right? How do you really embed them into your supply chains? We did a survey again recently where 33% of our corporates said that they had the policies in place, but they did not necessarily have a way to measure them. Right. ESG is also fundamental to how we build a resilient supply chain. So really doing, more around creating visibility, transparency, ability to, measure ESG, and really sort of doubling down efforts on building resilient supply chains would be some of the efforts that we are sort of seeing and we're talking to our clients about.
Interesting. Michele?
Yeah, very briefly, since I realize we are out of time, but on the scenarios going forward, I would just recommend to take a look at this recent study by the IMF on geoeconomic fragmentation. There are some scary numbers that I was mentioning also at the beginning of this conversation on how things could go in more pessimistic scenarios, and the message is very simple. To avoid those scenarios, we need to go back to multilateralism, and we need to go back to strengthen the institutions that oversee multilateralism, in particular the WTO.
Interesting. Thank you. Thank you very much for a fascinating discussion. I think this is going to stay with us for a while. It looks to me that this is a more strategic, actions to be taken in the near future, and then we need to revisit this. What has changed? I want to say 3 years from now, and really make it a case study. I'm sure that EY is going to do a lot of analysis around this, as well as the IMF. On how supply chain management has completely changed, and I expect from HSBC actually to tie that in with digitalization in the financial system, and how financing is going to drive a part of this development. Fascinating discussion, like I said. This concludes today's webinar. Thank you to our panelists. Thank you to our audience for joining us. And a quick reminder, if you're an ESCC member, we will be happy to connect you to some of the other attendees. And we have a number of very interesting events coming up. Among them, members only, the war in Ukraine, economic support, sanctions, and policy responses a year later. Immigration roller coaster, new headaches, and developments for 2023. Cyber attacks, what you need to know now and before they happen. ESG factors in M&A transaction and the DORA policy. All of the events are on the EACC website, and so will be a link of this webinar. Thank you again for joining us, and we see you at the next program, live at the immigration program. Thank you, everybody.
Thank you so much. Bye.
Thank you. Bye-bye.